I'm with Tom Sherman, my buddy with Benchmark Mortgage. And Tom,
Hey guys.
as we are in the middle of February, there is talk of interest rates bumping up. And I know how that impacts the buyer. It reduces their buying power. How does this impact the seller?
Yeah, it's a great question. Give me just a second to kind of talk about what is going on with the mortgage market right now. Because a lot of people don't understand that their perspective is that when the Fed say they're going to raise rates, that means they're raising mortgage rates. But that's really not what's happening. When the Fed raises rates, they're raising the interest rate that banks can borrow money from the Fed at. Okay, so indirectly it will impact interest rates for cars and mortgages and everything else, but they don't directly raise rates for the current mortgage rates.
Okay.
What's happening in the market right now is we're seeing significant inflation, some of the highest inflation we've seen literally in the history of the United States. And it's pretty crazy what's happening. And in order to bring that back down, the Federal Reserve has to raise interest rates so that it'll actually slow down the economy. That's the ultimate goal. And so that's what we're seeing now. So we're starting to see the Fed raise rates. They've announced that they're going to raise rates at least 4 times this year. And the mortgage market is reacting to that because it doesn't know what that really means. Is it 4 times? Is it 2 times? Is it 6 times? We don't really know.
Yeah.
And so the secondary market is starting to put some pressure on interest rates. We've seen interest rates climb into the high 3s, and in some cases even the low 4s currently.
Okay.
We're anticipating we could see them as high as the mid to high 4s by the end of this year. So that's a pretty significant increase.
Yeah.
Well, what does that mean for buyers? Well, clearly what that means is that if interest rates go up, borrowing money at that higher rate is going to cost the consumer more, right? So anybody who's buying a house or buying a car or credit cards or whatever, they're going to be borrowing at a higher rate of interest, okay? Payments are going to be higher, etc. That also means that if their payments are higher, it can impact what they can qualify for.
Yeah.
So, you're looking at a buyer who might have qualified for a $400,000 house. Now maybe they only qualify for $350,000. Okay. How does that impact the seller? Well, in a normal market, if you have fewer buyers that qualify for your home because interest rates are higher, you're going to have fewer offers on your house.
Yeah.
This isn't a normal market right now. So we're seeing so many offers coming in on our listings, as you know, that what we're anticipating is really that it's not going to have much impact at all on the seller market right now. Now, a year from now, a year and a half from now, it could, but right at this moment, we don't think it's.
Do you think it's the reduction of if the interest rate's going up, it's going to bring down the number of maybe buyers in that pool?
Oh, absolutely.
So maybe you don't have as many offers coming in.
I definitely think you're going to see a reduction in the number of offers coming in. The question is that going to impact the sales prices in the market? Nobody can answer that.
Yeah. But
we definitely will see. If you had 5 buyers that could make an offer at $400,000, today you might only have 3.
Okay. All right. Well, that's a hot mortgage minute with my buddy Tom Sherman at Benchmark Mortgage. We'll bring more of this in the coming weeks. Have a great day.
Much.